7, 6, 5, 4, 3, 2, 1. Happy New Year! Woo!
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going on.
Welcome back, everyone. My name's Paul. It's an exciting day today because today is the start of a new year. Yes, today is the start of the new 2021 tax year. I don't even consider New Year to be New Year anymore. 2021 has only just started today. And this is because the new ISA allowances have all been opened up again. Here in the UK, we have a pretty good investment vehicle called the Stocks and Shares ISA. ISA stands for Individual Savings Account. We get £20,000 tax-free to put into basically whatever we want. A lot of people put it into a cash ISA where it just earns like 0.01% in a bank, but you can also put these into an investment ISA, which allows you to start investing into the stock market tax-free. In the US, they have something like a Roth IRA, which is about $4 or maybe $6,000. I don't know for sure. But from reading all the YouTube comments, a lot of you from different countries in Europe, Ireland is one of the big ones, you don't have anything like this. And I can't believe that. I didn't realize the privileged position we were in compared to a lot of European countries. I mean, Ireland has nothing like this. And here in the UK, we have lots of different platforms for our ISAs. In this situation, I'm only talking about stocks and shares ISAs because I'm not really interested in any other forms of ISAs at the moment. You've got Vanguard, which definitely knows its customer base. Vanguard is probably one of the best and cheapest brokerages out there. It mainly does index funds, but I'm sure it's got a lot of managed and income funds in there as well. The fee for Vanguard is 0.15%, and that's on top of any of the ETF fees as well. So if, say, Vanguard's S&P 500 index fund is 0.07%, I have not checked that, but I'm pretty sure it's close to 0.07%. On top of that, you'll have to add your 0.15% of Vanguard's platform fee, which isn't bad. That is still pretty damn cheap. You've also got Hargreaves Lansdown, which is the behemoth of the UK brokerages at the moment. Hargreaves Lansdown will give you access to a number of different stocks, ETFs, and open-ended investment trusts. Fees are pretty damn high with these guys though. It's mainly because they are the safest and, kind of the most premium sort of service in the UK. If you've got a hell of a lot of money, you don't mind spending 11 quid on every single stock trade, and their yearly charge is 0.45%, which is quite a lot, especially as a lot of their funds charge quite a lot on top of that as well. But with Hargreaves Lansdown, you apparently get what you pay for. You get a lot of premium, you get a lot of people calling you sir, and you get a lot of safety, apparently. That safety and trustworthiness you expect from a large British financial institution. You've also got free trade, which is apparently for colorblind people because I hate looking at this website. The colors on this website are terrible. Apparently it's good. I get a lot of YouTube comments with people suggesting it. Great stuff. You can get an ISA with them for just £3 a month. That's, to be fair, I don't think that's that bad. I think that's pretty good. For this year at least, I've decided to continue with Trading 212, and it basically does it all for you straight away. I've even put in £1,000 a day to start spending on my top dividend picks for 2021, which I'll go into in a second. What's also very important to remember is that after April 6th, you will be charged a 0.15% FX fee. So any stock that you buy from the US or Europe, you will be charged 0.15% on the buy and the sell of all of your stocks from now on. But one thing that did make me happy was David announcing that dividends don't count. That was one thing that was pretty scary for me because I'm going to start receiving a lot of dividends going forward. Any funds that we receive from dividends abroad don't count with the FX fee. Music to my ears, I love it. However, it's worth reminding you that this doesn't count for reinvestment. If you decide to reinvest those dividends back into US stocks or back into European stocks, you will still be charged a 0.15% fee. I get it, I'll have to live with it. Trading 212 have got me for another year. So today I'm briefly going to go through the first 4 investments I'm going to make of the year. And these companies are 4 dividend pairs that I think are going to be very strong going into the future. First up, Legal & General. Legal & General, to me, is starting to get on the high side, but I still believe it's undervalued. Genuine Impact is rating Legal & General as a very high quality company and only getting higher quality as well. It's also rating Legal & General as very cheap, and I'm not sure I totally agree with that, but I can see where they're coming from. Genuine Impact uses very well structured formulas to come up with its analysis. And having a quick look in, I can see that Genuine Impact is basing its valuation on the amount of cash that Legal & General has. I mean, that's not a bad way of looking at things, but it doesn't tell the entire story, particularly with the way that Legal & General is structured. It's quite a complex company. But they're right, Legal & General does have a lot of cash, and it is generating quite a lot of cash as well. When looking into Legal & General, you sort of see quite mixed numbers, to be honest with you. This is their 2020 final outlook, what you would call a 10K. And if you are just taking a look at the graphs as is, you'll see that there's a 2-year decline in operating profit and also a 4-year decline in earnings per share. So these are things that you need to be looking out for with Legal & General, but Legal & General just doesn't seem to work in the same way. Again, other graphs like EBITDA and return on equity do not look great when you're looking at Legal & General from just the perspective of the graphs. And what took me a very long time to consider with Legal & General, and it took me quite a long time to get my head around this, was the Solvency II surplus and coverage. Solvency II is an EU law for insurance companies where they have to basically be able to cover everything that they're insuring. It's so we don't have another 2008 style crisis. And I think under Solvency II, and I'm going to butcher this, I know I'm going to butcher this somewhere, something with what I'm looking at right now will be wrong because there are so many little pitfalls with Legal & General. I still don't fully have my head around it. But I think that under Solvency II, you have to have 99.5% of your assets covered in your business as cash. And Legal & General currently cover 177% of their assets as cash. So they're an extra safe company. They're almost doubling the amount that they're legally required to have in cash. So in theory, if they did decide that, oh, there's a business opportunity here that we must have, there just might be something there that they can dip into. And I think they are waiting for something like this because the head honcho, who is Nigel Wilson, does think that there is going to be a big thing coming with Brexit. And to be honest with you, I'm not so worried about these losses in earnings. 2020 gave Legal & General a little bit of a bashing, but I think there's a lot of things that could come out of 2020 that could be really beneficial for Legal & General. There's definite risk to real estate and there's definite risk to medical bills. Legal & General is quite a heavy medical insurer, so there could be a lot of long-term effects coming out of COVID. But coming out of the pandemic, a lot of people are now considering income protection. A lot of businesses are considering it too. And there's a lot of people now thinking a lot more about their future. And lots of analysts are thinking this too. You see this drop in EPS? You can see it on fast graphs right here. Here's 3 to 4 years of earnings losses. We were down 8% in 18, down 6% in 19, and down 25% in 2020. But look what we're looking at in the future. 50%, 7%, and 10% gains over the next 3 years. I don't think there's going to be much of a PE expansion, but I do think there's going to be quite a bit of capital appreciation coming from growth. And then to top it up, you've got an over 5% dividend yield, which is pretty juicy as well. A-level credit rating, low debt to capital. I really think Legal & General is a really good business, and I will be adding hard going into 2021. What's more, just looking on Genuine Impact again, this is a great feature on Genuine Impact now. I'm so glad they added this. Ex-dividend dates, April 15th. So if you're going to get in on Legal & General's pretty juicy twice yearly dividend, you've got till April 15th there. Just very quickly here, I'm going to buy 100 shares. I don't actually know how much I'm going to properly put in yet, but 100 shares is way less than I'm probably going to eventually put into it. So I'm just happy to buy this right here and just for the video. Oh, I'm very quickly going to add 125 to the S&P 500 right now. Even though it's at all-time highs, it does feel a bit painful to do this. I plan to put 5% of all of my deposits into the S&P 500 ETF at VUSA, and that basically tracks what I could have done with the S&P 500 with my money rather than put it into dividend investing stocks. Because we can see right now that my income pie is 13.42% up in comparison to 12.49% up, which is great. Very marginally beating the S&P 500 right now. The second dividend stock that I'll be buying for 2021 is Rio Tinto. Rio Tinto is a mining company. Genuine Impact has it as a very high quality company and a cheap company. Again, don't quite understand why Genuine Impact has it as so cheap. Looking through it, it looks like high cash flow is exactly where Genuine Impact thinks this valuation is worth a cheap valuation. It's pretty cheap. It's not that cheap though. Rio Tinto is having an amazing time right now. This is due to the iron ore price spiking massively. Iron ore and in general all commodities are having a really good time right now. They're going through another big cycle. Some would even call it a super cycle. Iron ore prices, in fact, are almost at absolute all-time highs. And these metal prices are doing wonders for companies like Rio Tinto, BHP, Albemarle, anything in any metal space ever, really. I think even gold is doing pretty well right now. And all these estimates that you're seeing right here on Fast Graphs were all priced in way before Biden announced his infrastructure plan. Biden's $2.3 trillion infrastructure plan was a surprise in general. China's been doing massive infrastructure spending. India has been doing that as well. So that has been pushing Rio Tinto up. Rio Tinto is a global mining powerhouse. It'll get in anywhere. It also is very ethically ambiguous. That's an understatement, isn't it? But Biden's infrastructure plan are going to do very well for iron. It's going to do very well for lithium, which I don't think Rio Tinto is very much a part of. But it is also to do with copper. And I've been really bullish on Rio Tinto getting into copper and really benefiting from the US going into all the renewable energy stuff. It looks like that might not go as well as I thought though, because Biden doesn't seem to be really pro Rio Tinto and BHP getting into copper. The Democrats have a real balancing system with being ethical versus mining the shit out of their country. They also don't want to just give mining to all of the other countries like China. So they've got a real delicate balance that they've really got to try and work on. So permits for copper are going to be a little bit more strict, and unfortunately as British companies like Rio Tinto and BHP don't have a ton of, what's the word I'm looking for? Lobbying was the word. As foreign entities, they don't have brilliant lobbying capabilities. That's what I meant. And according to analysts, this cycle is very much known about and is very much in play right now. However, Rio Tinto, at least in the short term, has a very long way to run. As soon as Rio Tinto starts shouting about some of these massive results that they're getting in late 2021, the stock price is probably going to respond really well. But don't expect this to continue too far into the future. Also, don't expect Rio Tinto's dividend to always be as big as it is right now. Because as with all mining stocks, the earnings depend on exactly what the spot price is of the thing they're mining. Iron ore is at all-time highs right now, so buying in at this later stage of the cycle might not be the best sort of value investing type move. However, with the announcement of this new infrastructure plan, I still think it's got a little bit longer to go. My third dividend stock for 2021, and it's an absolute no-brainer for me, is Bristol Myers Squibb. Bristol Myers Squibb is sitting here with a PE of 9.24. This company is due a massive, and I mean absolutely colossal PE expansion right now. Bristol Myers has historically averaged at a PE of 20. This could be a huge capital appreciation in a stock, not to mention that it's got a 3.16% dividend yield, an S&P credit rating of A+, and a 54% long-term debt to capital. So Bristol Myers Squibb has both the potential of a PE expansion followed by some real good solid cash flow growth. And what's most important about pharmaceutical companies is their pipe. You can't really go into Bristol Myers Squibb without mentioning their pipeline. This is the pipeline of drugs that Bristol Myers Squibb currently has going through just phase 3. It has about 20 drugs, and not to mention there's one of their drugs which is called Opdivo, one of their most famous and probably one of their most profitable drugs right now. It is going through numerous phase 3 trials right now to really open up what that drug can do for the world. The pipeline on Bristol Myers Squibb and their future going into pharmaceuticals is absolutely massive. And by no means am I advising you to get this stock, because you have to figure out all this for yourself as well. But my passion for Bristol Myers Squibb right now is absolutely immense. I see it as a brilliant company to hold if you're a value investor, if you're a dividend investor, and most importantly for the growth. The growth here for Bristol Myers Squibb could be massive, and at a PE of 15, and that's being really conservative, just giving Bristol Myers Squibb a nice 15 PE ratio. In my opinion, there is a large margin of safety on Bristol Myers Squibb right now. If it only expands to a PE of 10, you're looking at a share price of around $86 in 4 years. That's a total return of 11% each year. That, for a really bad case scenario, is still a pretty good return. If it goes to 15 price to cash flow, you could be looking at $123 in 4 years. That's almost 100% return. And not to mention, if it goes back to a price to cash flow of 22, and this is a really good situation, this would be a bit pie in the sky sort of level situation, you'll be looking at a share price of $185, which is a 200% return in 4 years. That's how I feel about Bristol Myers Squibb, but it really does have to generate investor interest, and I don't know how it's going to do that. So the fundamentals of this company look really good to me. I just don't know why it's not being seen by that many investors. Speaking of changing the narrative, my final big investment of 2021 will be AT&T. I do keep banging on about AT&T, but I really do think this company is undervalued and it has lost the interest of the public. I feel this is allowing me the opportunity to keep accumulating shares, and I'm getting paid a 6 or 7% dividend in the process. I'm being paid just to wait, I think. Over the past 8 years, AT&T has lost 12% in capital appreciation, but you would still be up 3.5% if you had kept that dividend. I don't feel like there's much of an opportunity to lose money with AT&T right now, but the upside possibility on AT&T is very, very high, with a 17% year-on-year return. Double-digit returns are very good in the value investing world, so I'd be very happy with 17% year-on-year return on AT&T. Again, like Bristol Myers Squibb, I think AT&T is ready for another PE expansion. That's one way to get AT&T growing again. But with AT&T, I really think there's a growth story here being missed because everybody is looking at AT&T's debt. AT&T is really transparent with its debt. It lets you know exactly where all the bonds are, how much they cost, and when they're going to expire. It's got some expiring as late as 2066, 2067, and 2095. And currently they're saying their total debt at the moment is $157 billion, which is a hell of a lot. But when you look at AT&T's cash and listen to their CFO, you understand that it's completely covered. A lot of people can't get past this, and they're missing the true story of AT&T, which is HBO Max, which is likely to be probably the third best streaming service in the world eventually. And AT&T are already upping their subscriber projections, which is really good news. I think when in comparison to Disney, they are pretty comparable as a content creation machine. And in comparison to Netflix, of course, their content is so much better than anything Netflix is churning out right now. I'm more than happy to take quite a large bet on AT&T because I think the risk in here is actually quite low. I would have loved to have had it stayed at, say, $27 right now, and I may consider it. I may consider buying some after the ex-dividend date. I'm not entirely sure yet, but I'm more than happy for now at least to continue buying AT&T and just waiting and getting paid to wait for that growth engine to start. So I think I'll leave it there. My current portfolio is sitting at 24,340. Next week, I think I will take a good look at all my portfolio. I think I'll do a Peter Lynch style, elevator pitch for each one of these, and then I'll decide if I'm going to keep them at that time. Thank you very much for watching, guys. The investment app that I use is called Trading 212. If you wanted to get into investing, you can sign up through a link in the description below. If you sign up through that link, you can get a free share that's worth up to £100. I get a free share as well. I also use eToro to buy my Bitcoin. Oh, by the way, on Bitcoin, big shout out to Nick who sent me some t-shirts. I don't get sponsored by that or anything like that. He's just a nice guy that sent me some t-shirts. He's got a Redbubble account. If you have a look in the link below, you can take a look at some of his t-shirts. He's just a nice guy, really. Check out the Discord. I'm on this Discord every single day chatting to absolutely everyone. Everyone's really friendly. Get yourself in here. And this Discord is completely free until it just gets too much to manage. Also, check me out on Instagram. I post a lot of different things that are happening as they are happening. So check it out on there. Whatever. And also, Genuine Impact is that little app I've been using to get all those stock analysis. So if you wanted to sign up for that as well, there's a link in the description below for that. Thank you very much for watching, guys. And if you enjoyed this video, please feel free to like, subscribe, and invest. And Happy New Year!
I'm amazed how many people own stocks. I'm amazed how many people own stocks. sucker's going up.
Just kind of brush this away for a bit. I'm going to be pulling confetti and glitter out my ass for weeks now.